Hi everyone, good morning, good afternoon, and good evening, right? Depending on which part of the world you're in. I'm over here in Singapore, so it's pretty late afternoon already, so I guess more towards the evening side. So good evening everyone. Welcome back to today's FP webinar, right? It's with me, your presenter for today, that's Isaac, and today I'll be covering advanced stochastic strategies. Right, hi Travis, right? Fantastic to have you here with me. Okay, always great to be in the presence of familiars, right? And the kid, right? I definitely remember that name as well. And hi Michelle, also remember you, right? So fantastic. Thanks always, for taking time out of your busy schedule to join me. All right, so very quickly, I don't want to waste too much time. Let's go on to the disclaimer. If you guys can greet me, I'm sure you guys can hear me. You guys can see my screen as well, and you guys can see my face, right? More importantly is to be able to see my screen, not so much my face, right? If my face is taking too much of your screen space, please just minimize it or something like that. Okay, so disclaimer first, understand that the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. Now, FP Markets has made every effort to ensure the accuracy of information at the date of publication. FP Markets does not give any warranty or representation as to the accuracy, reliability, or completeness of the information contained in this material. Having said that, it is my duty as the presenter to ensure that whatever I share with you guys is as accurate as possible at time of presentation, and the things that I share really for informational purposes only. Okay, so just a little quick introduction about me, right? My name is Isaac. I'm based over here in Singapore. Okay, I currently hold the CMT and CFTE certification, and I'm currently the co-chair of the CMT Singapore chapter, right? So that's really the Chartered Markets Technician Association. Okay, so I hope you guys are a bit more relieved now that you guys are in relatively good hands. Okay, so I'll try not to say anything crazy, okay, and definitely let you guys know where I'm coming from when I'm doing my sharing. So very quickly, we are going to be covering stochastics today, as I will share with you guys as much as I know about stochastics. And this is really the agenda for today. First and foremost, we start off with introduction to stochastic. What is this stochastic oscillator indicator that we're talking about? And then we'll move on to identifying hidden support and resistances with stochastics. And then after that, we'll talk about using divergences on stochastics and how we can fake out. We can avoid fake out. Not we can fake out, right? If you can fake out of your trading position, it's going to be pretty impressive. But how we can avoid fake outs with this stochastics indicator. Now at the end, if there is time, if time permits, right, I'll try to put everything together and try to show you guys how stochastics can actually be a very good and useful tool as part of your trading war chest, right? Your part of your indicator war chest, so to say, when it comes to helping you find trades. Now, I have to admit, there are a lot of people out there that do use stochastics. There are a lot of people out there that teach on how to use stochastics. I am pretty sure that you guys will not hear the way that I'm going to share with you guys. Okay, the way that I'm going to teach and share with you guys about stochastics is going to be slightly different from what you can find on Investopedia, on what you can find on Baby Pips, that kind of things. Okay, so it's based over my professional experience where I've used stochastics, and to a certain degree, I think stochastics is pretty accurate. More accurate actually, I feel, than RSI. Okay, so if you have to ask me to recommend you guys an indicator, first and foremost, my indicator that I'll recommend to you guys without fail would be the MACD, right? And then following after the MACD, my next second favorite will really be the stochastics oscillator. All right, so hi Bartholomew, good day to you as well, right? Thanks for taking time out of your schedule to be here with me. Okay, so let's quickly move on to the first topic of today, introduction to stochastics oscillator. Now, I know that there are some of you here with me today that you guys, I mean, you guys are familiar, right? I see your name quite often. So I know you guys are also pretty experienced or have slight experience already. And I'm pretty sure that there are some hidden people out there that the Chinese have this saying, right? There's always a bigger mountain, right? And I'm sure some of you have more experience than me. Okay, so I hope what I share today will be a good refresher for you guys. I'll try to keep it mid-level. If I'm too quick, let me know. If I'm too slow, let me know as well. Now, at the end of the webinar, there will be no Q&A session because I don't normally like doing Q&A at the end. If you guys have questions along the way, just throw your questions at me along the way and I will do my best to reply them. If there are multiple questions that are of similar nature, I will group them together and reply them when time permits. Okay, so I just want to introduce the stochastic oscillator indicator to you guys. Short form, we call it the stochastics, or otherwise it's just called the stock, right? S-T-O-C-H, right? We just call it the stock. So what is this stochastics oscillator about? Hey, just a very quick background. The stochastics oscillator is actually is another one of the popular momentum indicators that have been developed in the late 1950s by this guy called George Clooney Lane. No, I'm kidding. Okay, the C doesn't stand for Clooney. I don't really know what the C stands for, right? But George Lane, right? So Mr. Lane actually developed this stochastics oscillator and he actually applied it in the markets, right? Because the story is that the RSI did not really fulfill its purpose according to him, right? He didn't want to just have something that has that compares the relative strength index across different counters, right? He really want to measure the momentum that is within the stock counter itself. Okay, so over here theoretically speaking, it says that the oscillator does not follow price, it does not follow volume, but rather follows the speed or momentum of prices. Now, this is something that is very, very, very interesting, right? When it comes to momentum, okay, I have no idea how many of you are CFA holders. I have no idea how many of you actually have a career as a fundamental analyst, right, where you actually look at ratios and you prepare a long report, and then in the entire universe of equity counters, you actually compare, and then after that you study the stock fundamentally, and then you make a proposal to your investment director, and then they give that proposal to the clients. Okay, now I have had, for lack of a better word, a more gentle way of saying it, I have had plenty of discourse with my friends who are actually fundamental analysts, right? Be it whether they are within the hedge funds, be it whether they are seated within the banks, right, or on the research side of the banks. So they're always telling me, hey Isaac, why do you subscribe so much to technical analysis, right? Technical analysis, how useful can it be? Technical analysis is not good for the long term, it's really only good for the short term. Technical analysis is really something that is sort of a confirmation bias, in a sense, self-fulfilling prophecy, right? Everybody sees a triangle pattern or a channel and they immediately zoom in on the pattern and then they play the breakout in the expected way it's supposed to go, right? So how can you say that technical analysis works? Okay, and my counter to that is, I don't try to disprove that fundamental analysis doesn't work. Rather, I tell them that, hey, the one thing that you guys as fundamental analysts looking at ratios are unable to properly pinpoint out and account for is this thing called momentum. And momentum is something that really underscores technical analysis. Now, the Dow Jones Industrial Average, right? Charles Dow, the father of modern day technical analysis, okay, one of the founders of Wall Street Journal, right? He came up with the Dow Jones Industrial Average, the transportation index, really because he wanted to look at the momentum of stocks, comparing the momentum of these stocks against each other and also against the broader market, right? So and only technical analysis is something that can really account for momentum. So there are quantitative momentum models out there, right? I have friends that are running such models, and it's really also based on technical analysis. So they are looking at momentum indicators such as stochastics. They're looking at MACD, right? Moving average, convergence, divergence. They're looking at ADX, right? They are looking at the commodity channel index, the CCI. So all these momentum indicators, right, is something that people actually factor into their momentum models out there. Okay, so momentum for you guys as sort of a soundbite is really something that fundamental analysts will really find it a bit hard to price in when they are doing their analysis from a fundamental point of view on certain stock counters. Okay, so this is what George Lane tries to do. He actually created this oscillator, this stochastic oscillator, to measure momentum, the speed of prices. All right, so a lot of you guys would actually, I'm sure you guys are actually using stochastics. Do you know that stochastics actually has 3 components? Okay, we have the fast percentage K, we have the slow percentage K, and then finally we have the smooth percentage D. Now, but if you load up your chart on TradingView, right, you normally only have 2 lines on the stochastics indicator. So which are they referring to, right? Even on TradingView, if you were to do the settings, right, you only see percentage K, percentage D. You don't really know what percentage K you are looking at, whether it's the fast or is it the slow or is it the or some kind of hybrid percentage K. So I'm going to try to break it down for you guys. Now, when it comes to looking at indicators, my premise is always the same. Okay, I try not to go too much into the mathematical theory that underlies the indicator, because my view is always that, I give you an X, right, and I tell you, hey, maybe Bartholomew, right, or Travis, or Michelle, right, for example, this is an X. I want you to chop down as many trees as you can, and the more trees you chop down today, I will pay you more trees, more cash, right? Sorry, not very eco-friendly. Okay, so not very eco-friendly, right? Or maybe, yeah, but this just for illustration purposes. So what I'm trying to say is, at the end of the day, the person who's going to chop down the tree, are you really going to wonder, oh, what sort of metal is this X head made out of? Is it cast iron? Is it stainless steel? Is it aluminum, right? Or is it copper? Okay, or what handle is this wood made out of? Is it teak? All right, that kind of things. Are you going to think about what how your X is being made, or are you going to think about, okay, how am I going to use this X in the most effective way, where I use the least effort yet I get the most out of it? Maybe I swing it with a certain kind of angle. Maybe at the last moment I tilt the X head a bit higher so that it drives in deeper into the trunk of the trees. So the premise is the same, right? At the end of the day, I don't want to focus so much on the mathematical calculation behind the indicators. I want to focus more on how we use it in real life, right? So you can know the mathematical calculation and whatsoever, but if you don't know how to apply it, you're not going to get paid. It's just that simple. All right, so let's move on. So there are 3 components: fast percentage K, slow percentage K, and finally percentage D, right? What are they? Now, the stochastics model, right, the stochastics indicator is really built upon this value called the fast percentage K. So how do we calculate the fast percentage K? The fast percentage K is determined by using the current close of the current session minus the lowest low, all right? The lowest low, depending on the look back period, divided by the highest high, again, of the look back period, okay? And then minus the lowest low again, right? Once you get the value, you normalize it, you times 100, you get the fast percentage K. Now, when that happens, all right, you normally get a very jagged, okay, you normally get a very jagged, what do you call that, fast percentage K. So it will look something like that, right? It's pretty jagged, okay? And because it's so jagged, what people do is they actually smooth it out, right? So in technical analysis, at the moment you want to smooth out an indicator, very simple, just throw a simple moving average onto it, okay? So it's smooth. This fast percentage K, because it's choppy and sharp, is normally replaced with a slow percentage K. And how do we get this slow percentage K? by using a smooth, simple moving average, okay, value X, depending on the period that you're looking at, right? You apply it onto the fast percentage K and you get this thing called the slow percentage K. Okay, so you get the slow percentage K relatively smoother. Now, apart from just the slow percentage K, we want to get a signal line, right? Because you just see that, people want to know when really is the point where the stocks, where the asset class is overbought or oversold, and when is a good time to enter, right? So theoretically speaking, to get a signal line, they apply another simple moving average to further smooth the slow percentage K, right? And with that, they actually derive the percentage D line. Okay, so with that, you smooth it further, you get a very nice and smooth percentage D. Okay, so at the end of the day, what you see on your stochastics indicator is normally the slow percentage K and the percentage D line, right? So it's smooth, and then the percentage D is double smooth. All right, now that is really what stochastics is all about. Okay, some key points to note, let me just move forward. Some key points to note is that a stochastics oscillator takes a value between 0 to 100. All right, so it's only 0, okay, to 100. That's the upper limit and the lower limit, right? And then in the middle, sorry, let me just change the pen color. In the middle, normally what people would do is they would have a boundary of the upper bound of 80 and a lower bound of 20. Okay, let me just erase all this. Okay, I'm going to draw it below here. All right, so that there's a lot more space. 20, and then we have 80 over here. Okay, and then of course we have we had orange. Okay, and then you have 100, the upper limit, and 0, the lower limit. Okay, so this is really the band of the stochastics indicator, right? So what happens? Okay, generally when readings are above 80, it means that there is very strong bullish momentum. Price is overbought, right? The asset is overbought. On the flip side, readings below 20, okay, it means that the asset is oversold. There is market is at a higher level of, is at the extreme end of a bearish momentum. So imagine the stochastics is something like that. Okay, we are here, we are above 80, market is already overbought. Stochastics goes down, we're below 20, market is oversold, something like that. All right. Now, one thing to note is that stochastics indicator should be used only in generally sideways market. So for those of you who like to trade within tight market ranges, who like to fade support and resistances, okay, stochastics is really one of the most beautiful indicator for you that you can use as part of your trading. All right, so people like to set the band 80 and 20. Later on, I'm going to show you guys a completely different way. We're going to throw away this 80 and 20. No point looking at it, okay? It's just going to confuse you even more, right? Because you're going to have to look at the signal line, you're going to look at the 80-20 level, and then you're going to look at where the signal line crosses above or below the slow percentage K. It's going to get very confusing. Too many factors, guys. Let's just keep it simple, okay? One more thing, one more caveat to note about stochastics is that divergences can be misleading, right? I will cover a bit on divergence later. Now, you guys have to know that, divergences, according to Warren Buffett, right, the market can remain divergent longer than you can remain solvent. I will show you guys a few examples later. So in preparation for this webinar, right, I was actually going through some charts and just looking through some examples, okay? So this is some of the key points of stochastics. All right, I hope you guys are clear. Any questions so far? All right, if you guys got questions, please just fire them away, all right? Okay, no questions, let's move on. All right, now I will move on to identifying hidden support and resistance. What does that mean? Okay, let me just go back one slide because I want the black background. Okay, the darker background. Now, traditionally, what people do is, okay, when stochastics enter, let's say prices are trending higher, right? Prices are trending higher. So stochastics actually enter the 80 region, right? The band, the upper boundary, right? This is a signal. This is the first signal for traders to say that, oh, okay, this stock, this instrument that I'm looking at is overbought. Okay, do I sell now? No, I don't. So what people do, they wait for stochastics to come back down, break below the 80. Okay, the moment stochastics breaks below the 80, that for them is a signal to sell. Okay, that for them is a signal to sell. The opposite is true, right? The opposite is true. When prices are on a downtrend, okay, they're going lower, right? That is when you see a stochastics falling. It enters below the 20 zone, all right? It is oversold, okay? People do not, the way that people use stochastics, they do not immediately buy, right? They wait for stochastics to cross back above the 20, this level. Once stochastics is above the 20, that's when they enter to go long, and then ideally prices should go higher in line with stochastics. Okay, so this is how the traditional way of using stochastics is being done. All right, if you guys are clear, let me just move over to the charts. Okay, I'm going to erase all drawing and let's go to the charts. Okay, so I have some questions from the kid. Which time frame are you applying my stochastic strategy in? Now, based on my past experience, okay, stochastics for me really works the best below the daily chart. So time frame, okay, as long as we are below daily, so we are looking at 4 hour, 1 hour, 30 minutes, all right, that for me is really the best time frame to use stochastics. Stochastics do not really work well on the monthly and the weekly, right? So if you are a long-term position trader, you're a long-term trend trader, stochastics really will not be ideal for you, especially if you see a divergence. It's going to be a very painful wait. Okay, I'll give you some examples later. So I hope that answers your question. All right, again, it's daily. Daily is probably the highest time frame I'll go, but stochastics works best for me based on my experience. 4 hour, 1 hour, 30 minutes. Okay. Another question from Bartholomew: which of the indicator is best suited with Fibonacci? All right, Fibonacci on itself is already good enough. Okay, normally what I like to do is I like to look at MACD in line with Fibonacci. Okay, and coupled with my MACD, I like to look at moving averages as well. And then I sort of use stochastics as like a final confirmation when I really need to. Okay, however, if you want to trade just based off graphical and Fibonacci alone, Bartholomew, it's possible. All right, it's really possible, but you just have to be able to manage your trade well. So I hope that answers your question. Okay, so we are currently right now we are identifying hidden support and resistances. Now before that, I'm going to pull up my stochastics indicator here. As you can see, there's percentage K, there's percentage D. Really, this means the slow percentage K and then the double smooth percentage D. All right. Now for the numbers, I leave the 5 as per normal. Okay, and then I leave the smoothing as 3. I don't touch this. This is really the default. Okay, for the slow percentage K, I like to use Fibonacci numbers. Why do I use Fibonacci numbers? Now, the methodology that I really employ is the fact that, you know, Fibonacci numbers are sort of fractal in nature, right? So, and because they are fractal in nature, the markets are also fractal in nature. Fibonacci numbers work nicely on every time frame, which is why I like to use Fibonacci numbers. Okay, so normally my stochastics, I will be switching between 13, 21, and 34. All right, these are the 3 numbers that I normally use. Okay, so over here, I'm just going to leave it as 21. Okay, and then I'm not going to touch the others. Okay, and what I'm going to do is I'm going to have the upper band at 80. So let me just put a straight line and a thicker one. Okay, possibly use a nice red. Okay, no, Nice pink color. The contrast not very nice. Okay, never mind. White line. Okay, so 80 and lower band, white line 20. Okay, so I have the upper band and the lower band. All right, so I'm going to zoom in a bit. This is the 1 hour, right? So traditionally, having 80 and 20, you can see the stochastics, it never crosses above 100, never crosses below 0, right? So how this works, as I mentioned, okay, you see prices going up, prices are going higher and higher and higher, okay, and then finally stochastics, right, is breaks above 80. So it's at this point, right? It's at this point we break above 80. Okay, so it's very early on in the trend. We break above 80, and what happens? Do you immediately go short just because price is sort of overbought now? No, you don't, right? Traditionally, people wait until stochastics and the signal line breaks below. Okay, breaks below the 80 again, and then that's where they short. So this is the level where ideally you will go short. Okay, ideally you'll go short here. But look at that, what happens to price, right? Price continues to go up. Okay, so just based on stochastics alone, okay, it's never going to be 100%, right? Nothing in technical analysis is 100%. In fact, this will be a very painful losing trade for you. Now we're just going to scroll back a little bit more, and you look over here, very strong uptrend, right? Very, very strong uptrend. Look what happened over here. Price, okay, just give me a moment. Over here, the signal line and stochastics broke above the 80. Do we sell immediately? No, we don't. The moment when stochastics, the slow percentage K and the percentage D breaks below, that is where we look to sell, right? That is where we look to sell. But by then, the drop has already happened, right? So let's just say you are really good, you sniped it right at the top, okay? You sniped it at the candle open and you get a drop. And then you get a drop until where? Until over here, another line, right? Over here, I'm going to change this color to, let's say, maybe purple, right? Something darker so you guys can see, okay? Now, this is where you exit the trade. You'll miss this entire drop and you probably get a couple of pips, say maybe about 23 pips. All right, so the classical way, okay, the classical way of using stochastics, right? It does work, but it doesn't work 100% of the time. And even when it works, all right, sometimes the momentum can be so strong, stochastics can move so fast that you don't really get a lot out of the market, okay? You don't really get a lot out of the market. All right, so for this is the traditional way of using stochastics. I just want to show you guys another way. All right, so I'm going to remove, so we're going to identify hidden support and resistance. I'm going to remove the upper band and lower band. Okay, so Kit, you're saying, put the RSI on the chart and it will pinpoint the trade entry in combo with your stochastics. Very interesting. Yes, it is also possible to use RSI together with stochastics to actually further fine-tune the entry and exit. Okay, so definitely possible. Thanks for sharing that with everyone here as well. That's why I read out your message. I think that can be a value add, right? So putting the RSI together with stochastics, combining the two indicators can possibly fine-tune the analysis, the trade. Okay, but just be careful. Don't put too many indicators, otherwise you'll be confused. Okay, so too many cooks spoil the broth, right? But thanks for sharing. Anyway, since we are talking about stochastics, I will focus more on stochastics. So as I was saying, right, what I like to do is I like to declutter. For me, keep it simple, right? Just declutter. I will look at the percentage D. If you guys want, you guys can also look at percentage K. Not an issue, but I prefer something that's a bit more smooth out. So I tend to look at percentage D. Now, what do I do? Okay, generally speaking, I look at the extreme ends, right? Like how we normally look for support and resistances on the chart. You can apply the same principle over to stochastics. Okay, I look at the extreme end. So over here, I have dollar yen, right? Now, looking at all the peaks of stochastics, right? Over here, over here, over here, over here. I will just draw a horizontal line across. And that for me is, okay, I shouldn't use red, right? Red is quite a telling color. So let me just change the percentage D to black. Okay. So I have identified a resistance on stochastics. Now do that for support, okay? Looking at all the valleys, the lowest low, this point, okay? I'll just connect all this, right? Just take roughly as close to the lowest low as possible, as many touches as possible, and then have a support, right? So what does this tell me, okay? This hidden resistance and hidden support level is telling me that every time, instead of looking at the band, right, instead of waiting for price to go above 80 and break, instead of waiting for stochastics to go above 80 and come back down, or go below 20 and come back up, we look at the extremes, okay? Looking at the extremes, this is what we see, okay? When stochastics touches this level here, right, price drops, right? It makes a drop. Of course, there's a spike, but ultimately there's a drop. Okay, now we fast forward a bit. Okay, when stochastics touches this level over here, okay, it is actually a resistance on stochastics because price pulled back in the past. We can expect the same thing to happen. Now, of course, price sort of dilly-dallied quite a bit. All right, this doesn't work out 100%, and then after that it drops. Okay, so this doesn't really work out. Not an issue. We move on again. So same resistance level at a peak again, look what happened. That was where really price started to drop, right? And it made a very significant drop, okay? All right, and then we move forward one more time. We step forward with me, right? Stochastics tested over here, okay? Did price show a reaction? Yes, if you zoom in, you see a big red bearish engulfing candle. Of course, it dropped the next session. It continued upwards. So like I said, it doesn't work 100% of the time, but you do get a reaction. So the stochastics is still testing the resistance. Still possible to look for shorts. So over here, price pulled back a bit. You see stochastics dip a bit lower. Now at the same time, walk forward with me. Over here, stochastics tested the resistance and there was a much bigger drop in price. Okay, and over here, stochastics never tested the resistance at all. You will not enter, ideally you will not enter based on stochastics alone. Okay, so stochastics on the resistance, that is how we identify the extreme ends. Now, I just want you guys to walk forward with me again using the support. Okay, using the support. So let's go. Okay, I'm just going to drag it further back, okay? Now you can see that over here, stochastics actually tested the support and then it bounced, right? Price was at a low, it bounced, stochastic tested the support, it bounced. Stochastics came back again, came close to the support, and that was where price bounced, right? It didn't come close. Again, it's never 100%, right? So just take that into consideration. Now, stochastics tested this support again, this extreme low, and then that was when you have the start of a very strong uptrend. All right, over here, stochastics came close, but not as close as previously, not as close as what happened previously. All right, so probably you won't enter here. So price did a very strong push up. All right, you have missed this trade. Okay, let's be realistic about it. You have missed this trade if you enter based on stochastics alone. Walk forward with me. Okay, you see stochastics testing this support again where it tested previously, and price made a strong reaction. Again, over here, you have missed this trade, came very close, didn't see it at all, right? That was the start of an uptrend. Okay, and then over here, as recent as possible, there was a small reaction in price, stochastics reacting over here. Okay, this principle of hidden support and resistance can be applied to any time frame, all right, that you're using stochastics on any asset class. Okay, so just to show you guys, you can actually go to gold, all right, and it works as well. And this is the 1 hour. Let's look at the 4 hours. Okay, identify the extreme ends. just draw one line across, wait for resistance. Another extreme end over here, I would actually take this low because it seems like stochastics came close a couple of times. So I will actually take this low. So you see, instead of the 80-20 boundary, the real hidden resistance on stochastics is actually 94. That's the upper bound, right, for gold on 4 hours. And then the lower bound is actually 16.15 for stochastics on gold on 4 hours. That's the support. All right, so before I make you guys walk forward with me, okay, I have some comments. Okay, Andrew, can I please show the percentage K and D setting numbers on TradingView? Yes, of course I can. So let's look at stochastics. This is the input, right? So take a while. And yeah, just take a screenshot or something. Okay, so another sharing from Kit. Back on dollar yen, put RSI on the chart and it will pinpoint the trade entry. RSI extreme in combo with the stochastics. So RSI gives you a less risk trade setup. Use the stochastics for rotation to get in and out. Okay, so extreme RSI plus extreme stochastics. Okay, so use stochastics on rotations. Okay, so this seems like a very if I remember correctly, you are more of a long-term trader. So this actually does seem like a long-term strategy as well. Okay, so I just very quickly just go back to dollar yen. All right, and just put the stochastics there, and I will actually underline it. Okay, give me a moment. I will underline, just now we're on the 1 hour, right? I will add on the RSI here. Okay, so RSI also used in the same way. Okay, no need for upper band, nothing. Okay, no need for background. Okay, so you're saying, you know, look at the pinpoint the extremes on the RSI. You have the extreme. All right, so if this is a level, might want to go short over here. Okay, so if I'm going to zoom in on the chart, okay, there is a high where stochastics has an extreme, RSI has an extreme. You might want to go short here. Yep, you have to wait a while, and it kind of works out, right? It drops. Okay, same thing. Likewise, okay, stochastics on an extreme over here, RSI on an extreme, very nice. It goes for a drop as well. But ultimately, you can see, yeah, so you can use it to pinpoint, okay, RSI at the end of the day, the movement of RSI is also somewhat similar to stochastics, which is why you have this other indicator called the stochastic RSI. Okay, but the one we're talking about here is the stochastics oscillator. All right, so right quickly, let's go back to gold on the 4 hours. Okay, so I really want to look, I want to pinpoint gold on the 4 hours. Okay, at the start, right? Okay, this is no on the 4 hours. Where was I? Yeah. Okay, so you can see the extreme, right? Walk forward with me. Gold made a dip, okay, not the strongest dip. And then after that, okay, the RSI, okay, Robert, the RSI setting is for me, I'm not sure how the kid actually uses it, all right, but for me, I use the RSI setting the same as stochastics. So it's really Fibonacci numbers, 13, 21, 34. These are the main numbers that I use, okay? I don't like to use too big a number because then the stochastics or RSI will not be sensitive to price change. So I like to use slightly smaller numbers, okay? So we look at the red line, stochastics is at an extreme. Over here, quite close, but you probably won't go short as well, right? Price pushed higher. So this was a failed attempt. And over here, right? Gold price actually dropped just based off stochastics because stochastics was testing the extreme, right? And then you walk forward with me. Over here, slight drop before a further push up as well. So again, it didn't really work there, okay? And over here, stochastics approached the resistance and there was a drop. Okay, so we see that, you know, stochastics does work, but again, not 100% of the time, right? And very quickly, we do it on the flip side, the support over here, right? We see price bounce, walk forward with me, Stochastics came close to testing the support again. We see another small bounce in price, works here. And over here, we catch the start of the large movement, right? So it works. And then over here, once again, it works. And of course, over here, you have a smaller movement, price push down, spike back up, right? So you can say that ideally it sort of works, and then after it continues lower. Okay, so it seems like on gold, okay, the support on the stochastics seems to work better than the resistance on the stochastics. All right, so that is really how we identify hidden support and resistance. Now we move on to something else. Okay, something more important, not just identifying hidden support and resistance. What I really think will take up a big chunk of our time today is really divergence on stochastics. Now, as I've mentioned earlier, the caveat here is markets can remain more divergent than you can remain solvent. All right, unless you are the Federal Reserve and you can keep printing money, that's a different thing altogether. All right, then you can remain more solvent. You can remain solvent longer than the markets can remain divergent. Okay, so how do we use divergence on stochastics? Now, some of you will know that, let's just go back to the charts, erase everything. There are multiple types of stochastics, okay? One is there are multiple types of divergences, okay? One is prices going higher, okay? I'm just going to draw a line across, okay? The top, let me just give me a moment. Okay, golden line for divergence. Guess I don't have a divergence here. Okay, never mind. Golden line for divergence. Yeah. Okay, and this, so let's just say this black line, okay, separates the chart into two, right? The top is the price chart, okay? The bottom is the stochastics, all right? So when prices are making higher highs, okay? When prices are making higher highs, okay? And then you have the stochastics making lower lows, right? This is a classic divergence. Okay, this is a classic divergence. Okay, classic divergence you have there. Okay, prices making higher highs, stochastics or RSI making lower lows. It's just telling you that, hey, you know, while prices are pushing higher, all right, there is more bearish momentum. Remember, stochastics doesn't tell you about the volume of price. Okay, it actually measures the momentum. So it's telling you that there is more and more bearish momentum. So soon you should see price reverse. Okay, price should drop lower. All right, and then the stochastics, okay, either go higher, right, and then drop lower. Okay, so something like that. All right, but this is a classic. This is what I'll call a classic bearish divergence. Okay, it's a classic. The opposite is true. The opposite is true where you have a bullish divergence, right? Prices are making lower lows. Okay, and stochastics is actually making higher highs. All right, so what you have is a classic bullish divergence. Okay, all right, so there's some sharing. Okay, so from the kid, I'm spot on, thank you. You have a daily time frame trader for your trade entries. However, the extreme RSI, extreme stochastic is where the big institution drive price, ride their coattails, and only then exploit the lower time frames on stochastic rotations. So thanks for sharing. I can attest to that. Institutions do look at RSI and stochastics. All right, they do look at Elliott wave as well. Okay, so I'm sorry if I pronounce your name wrongly. Costopoulos. All right, you believe the saying, gold's market can remain irrational longer than you can remain solvent, but you get an analogy. Okay, yeah, I might have misquoted Mr. Buffett right there. So thanks for pointing that out. All right, market irrationality is something that we should never fight against. Okay, so we have the classic bearish divergence, classic bullish divergence. Just a rough idea. All right, one thing I want you guys to note is that divergences do not always work. Okay, I am just going to show you guys some beautiful examples of how divergence can work so beautifully when you combine it with the hidden support and resistance levels that we just went through. Okay, so I'm just going to cycle quickly. Okay, let's look at dollar yen. Dollar yen, I have it. Sorry, I'm going to keep looking down because I actually wrote it down. I don't want to waste time slowly scanning through. I want to try to maximize the time. So we have a bullish divergence on H1. Okay, let's go to H1. Okay, so we have a bullish divergence over here. You just look at the extreme lows. Okay, you just look at the extreme lows over here. Green for support. Just want to show you guys, and you need to look at the trend. Okay, so there is a divergent line here. So for me, okay, I don't like this orange color. It's a bit too, I want something darker. Okay, for me, now there are people out there who actually tells you, okay, divergence, you can just take it anywhere. The moment the indicator and prices go in opposite direction, that is a divergence. All right, personally, I beg to differ. A divergence has to happen at an extreme end. You cannot say that a divergence happens in the middle of nowhere, right? You have to say that a divergence happens at an extreme end. Okay, so for me, when it comes to an extreme end, that's where I start drawing my divergence. All right, and if you look, there is a divergence over here. Prices are making lower low, right? But we see bullish momentum building. And what happens after price comes close to the extreme support? All right, over here it bounces. We catch the start of a trend. So bullish divergence works beautifully. All right, in this example. Now, more recently, okay, you see another bullish divergence again, right? Stochastics is so close to the extreme here. There's a bullish divergence, right? Stochastics making higher lows, and price is making lower lows, right? So you have another bullish divergence happening again. The problem with the bullish divergence, the problem with divergence here is you don't know where the divergence is going to end, right? You just see that there's a divergence coming. All right, and you zoom out to the H4, you'll be able to see divergence as well. Over here, I have bullish divergence, so I'm just going to draw a support across the extreme levels. I'm not sure where did I see it. Okay, so you have a very nice, okay, you have a very nice bullish divergence here. Again, this is at the extreme end. Look at that, right? Prices dropping lower. Stochastics came close to the extreme and pushed higher. Bullish divergence, the start of a very long and beautiful uptrend, right? You see it right here, start of a very long and beautiful uptrend, okay? With multiple levels for entry to go long, to compound your position long, right? Okay, so take profit, I leave it up to you. And look, okay, over here, prices are going lower and lower and lower. Now, divergence, like I said, has to happen at an extreme. Okay, this is what I would say is a slight hidden divergence, okay, or not a very strong divergence. Why? Because stochastics is testing the same level. Essentially, the stochastics indicator is flat, right? But look at what price is doing at the same period of time. Okay, price is just dropping lower and lower, right, in the same period of time. So it's somewhere over here. Okay, so price is dropping lower and lower for a couple of days. This is on a 4-hour chart, right? So a couple of days. So if the moment you're gonna go short here on the first touch of the extreme support where stochastics is, you're gonna get burned badly, right? Because price is just gonna drop against you, and then you have divergence forming. Shortly after that, it's a reversal. Okay, so bullish divergence works nicely on dollar yen. Actually, it works nicely on every counter, right? Euro USD, let's go to Euro USD very quickly. Euro USD on the H4, right? We have bearish divergence, okay? Extreme ends, right? You want extreme ends. Okay, so I'm just going to take the extreme end over here, and more recently, look at that, starting from the peak, okay? something like that, right? You see, prices are making higher highs and stochastics making lower highs. Okay, classic bearish divergence. That is where you get a drop, right? A start of a very strong downtrend. Okay, now some people will argue, oh Isaac, what about this? Can this be considered a bearish divergence? Well, to get your answer, just extend the line from where you start off, right? Does this look like a bearish divergence? No. Okay, and this is not right at a peak, so I'll not consider this a bearish divergence, right? The bearish divergence was something like that. Okay, so that's an example on euro dollar. And very quickly we go to gold. Okay, works on commodities as well. Now I know we are a bit short on time. I just want to show you guys gold on the 4-hour. Okay, you have a bearish divergence and bullish divergence. Just look at the extreme ends. Okay, I'm just going to put blue, okay, because I don't want to waste time changing colors. I want to show you guys as much as possible. Okay, so you have a strong bearish divergence over here, right, from the peak to the next low over here, next high. All right, and then you can go short here, and look, that was where the drop really started, right? It went all the way down, right? Went all the way down. Now looking for bullish divergence, you have one over here, the support, the peak over here as well. I'm just going to zoom in, easier for you guys to see, right? Prices are making lower lows, and then stochastics is starting from the peak, generally going higher. So you have a classic bullish divergence over here on gold as well. Now for those of you who trade crypto out there, I really like this example recently, been using a lot of it. Okay, the markets was already giving a hint that crypto was going to drop from its peak. All right, on the weekly you actually have a, okay, on the weekly you actually have very clear divergence, right, on the stochastics. Hard to see, but you change to close. Okay, you draw from the peak, right? You do have a bearish divergence. Even clearer on the daily. Now the daily is very beautiful, right? You can readjust it, drawing from the peak as well. Okay, you can see that the divergence, you can further fine tune the divergence, right? Again, it only has to happen in the extreme. Now on the flip side, there is another very nice divergence on the lows, on the extreme end. Look at that recently. Okay, what is happening with price? You have a divergence right now. Okay, bullish divergence, but do you enter now? All right, possible, but where will your take profit be? Okay, again, divergence doesn't tell you where the take profit will be. Okay, so Bitcoin, you could have actually caught the drop before the markets really tanked, right? Before the markets really puked, right? The divergence was there. Now, a very simple example, okay, of how divergence can actually kill you, right? I like to look at the S&P E-mini futures. Let's go over to the long-term chart. Okay, so VJ, flag pattern can be at play as well for Bitcoin, dollar. Let's just go back to that, a quick one. Flag pattern, are you referring to more recent times on the daily? Okay, I personally don't see a flag pattern. All right, a flag pattern has to be very clear. There has to be a, if it's an inverse flag, has to be a strong preceding trend followed by price in a very clear sideways channel. Okay, if it's a normal flag pattern, strong preceding trend followed by price in a very clear upwards channel, something like that. Okay, so this for me is to be very strict with a flag pattern. If you're saying this is an inverse flag, okay, I can give this to you as the strong preceding trend, but for me this is not a very nice channel at all. Okay, not a very nice channel. Okay, price whipsaws around. If I take the extreme ends, then there is no nice touch. It's only one touch on each side. So it's too broad to be a flag pattern. Okay, so for me, this is not a flag pattern, all right, VJ. Okay, I'm just coming from a very classical chart pattern point of view, all right? I don't want to argue on technicalities, if you adjust and all that, just very strictly on a classical TA view. All right, so let's go back to S&P. All right, I want to show you guys, I think it's on the weekly if I'm not wrong. Right, so okay, yes, right here. Right, you take the extreme ends, okay, you take the extreme and look what happened. Price is making, okay, price is making a divergence, right? And you look, you take an extreme end, there's a bearish divergence, okay? Now price just drops for a short while. However, it continues to go higher and higher and higher, right? This divergence, okay, is going to kill you if you just keep waiting for it to happen, all right? And also back during the, wait, give me a moment, I'm trying to search for it. Okay, is it on the monthly? Trying to look for the monthly. Okay, it's not on the monthly, then it could be on the daily. All right, just a very very clear example of why divergence doesn't work that beautifully, especially when it comes to the S&P. Okay, so over here you have a slight, is it over here? Wait, give me a moment guys. I had to search for it. Nope, not there, not there. I'm thinking more recently. It should be more recent. Okay, so something, yeah. Oh no, I found it. What happened to my chart? Okay, more recently, right? Over here. Okay, you see that price, right? Price is starting to make price is starting to make higher highs over here. Price is starting to make higher highs. And if you draw it from the peak, right? The peak to peak. Okay, this is a very weak divergence. Okay, but you draw it from the peak to peak. All right, you expect to really, this is the daily, so you expect to have a bigger target, right? Now, price did a small pullback, okay? However, after that, it continued its uptrend again. And this portion here, if let's say you were to enter, if you were to enter the divergence at this portion, right? At this point, where's my arrow? Okay, if you were to enter divergence at this point, it's still not too bad because you actually do get a bit of get a bit of profits coming out from the market here. However, if you were to enter where stochastics reach the peak, right over here, stochastics reach the peak, all right, the start of the divergence, and then you go short, and then you start seeing that, oh, price are going higher, you still see a divergence, and then you continue going short on the way up. It's going to be a very painful journey on the way up. All right, so what I'm trying to point out to you here is that, while divergence does work, it doesn't work 100% of the time, and always wait for divergence to fully form first before you actually enter. Okay, because divergence doesn't tell you, right? Divergence doesn't tell you where the take profit should be. Okay, so Kit, you're asking, would I say divergence work better on individual stocks? If you ask me, yes, from my experience, divergence does work better on individual stocks. However, it can be applied to any asset classes. Okay, and would I say divergence work better on 4-hour time frame below as opposed to daily time frame? Now, divergences can be found on any time frame, but back to my first point, stochastics works better on daily and below, right? So then I would think that, I never really backtested this theory, very interesting. Okay, I would think that yes, divergences work better on the lower time frame. right? On the bigger time frame, it also means that if you're waiting for divergence to be formed fully, it's going to be very, very, very painful. All right, so if I'm going to zoom back out onto the weekly, right, something like that, okay, if you are going to wait for the divergence here to be formed fully, it's going to be a very, very painful wait, right? Because let's say you go short when price tested the peak, you go short, okay, yeah, you're happy, it drops a bit, and then after price continues going up, you see, oh, there's a divergence being formed, right? Only after the divergence is complete, then you enter, okay? But if you're really waiting on the way for the divergence to be completed, how long is this? On the weekly, you're going to be waiting for about a total of 196 days, right? 196 days. That's about 1/3, right? 1/3 of a trading year gone. No, yeah, slightly more than 1/3 of a trading year gone. Okay, so this is going to be very painful when you apply divergence on the much longer time frame. Okay, oh wow, I didn't realize that we kind of ran out of time. Okay, so very quickly, avoiding fake outs with stochastics. Now, there really isn't much to say about avoiding fake out with stochastics. If you combine point 2 and 3, okay, identifying hidden support and resistances using the extreme ends, all right, you won't really be caught out with a fake out. Coupled with that, if you wait for the divergence to be formed, all right, the market is not going to fake you out that easily. Okay, so how do we avoid, just to keep things very short in the interest of time, how do we avoid fake outs with stochastics? Is really to put points 2 and 3 into practice. Okay, so putting point 2 and 3 into practice will help you avoid fake outs. Okay, and the whole concept of having fake outs on stochastics is not something that happens often. Why? Because again, stochastics doesn't look at price. Stochastics looks at momentum. Okay, so the idea of having fake outs is not going to really happen with stochastic, because once there is, let's say price is bullish, all right, and then there's an increase in selling pressure, all right, the bullish momentum is dying, bearish momentum starts building, you will see stochastic starts turning the other way around, all right, and you won't really get a lot of fake out in that sense. Okay, so at this point in time, I just want to be sure that you guys have no questions whatsoever. I am so sorry again, you know, for always taking up so much of your time. Okay, do you guys have any questions with regards to stochastics, hidden resistance, supports, looking at the extreme ends, looking at divergences? Okay, so very quick one from the kid looking at oil. All right, I'm thinking UK oil because it's Brent, right? Brent crude oil. Okay, so over here on the monthly, right, we are actually approaching a peak already. All right, quite close, which is why I said last week, okay, that oil for me has very limited upside. All right, oil for me has very limited upside. Okay, and then you go down to the weekly. All right, there's no sign of divergence or anything. You can adjust the peak a bit more. No sign of a divergence. All right, so still bullish. Okay, and then you can just, based on stochastics alone, right, you go down to the daily. Okay, daily there is a slight divergence, but the divergence is not completed yet. Very, very slight divergence. Okay, so you might be seeing a small short-term pullback, all right, before a bigger drop. And then of course on the 4-hour, you start seeing things a bit clearer, right? The divergence on the 4-hour is starting to be seen much clearer over here. Okay, but again, you see when there's a divergence forming, prices are still going up, right? So divergences do not always work 100% of the time, right? You need to compare that with the extreme ends, right? So on the 4-hour, stochastics is already so low, right? There is no point going short. Okay, what you want to do is look at the extreme ends, right? We are actually quite close to support. Okay, in fact, stochastics might make a bounce. Okay, so this divergence could already be completed. All right, and then you can go down to the 1 hour. Okay, you can see that price is already turning on the extreme. Okay, stochastics, just by looking at stochastics cycling through the time frame, is already telling you that, hey, this divergence might really have been, really might be over. Okay, so I hope that answers your question. Okay, so oh, fantastic, right? You're long and up 120%, so looking for an exit. Okay, so yeah, that's really awesome, right? I have been long oil for quite some time as well. I still think there's a bit of upside, right? Because the bullish momentum is just so strong. Okay, so with that, I would like to call it a day. Okay, you're welcome, Alex. You're welcome, Robert. You're welcome, Daniel. Thanks so much, everyone, for your time. If you guys have any feedbacks at all, please email support@fpmarkets.com. Right, the team, the excellent team there would actually reply you. And for all upcoming webinars, okay, please go to fpmarkets.com/trading-webinars/ you can look at our entire schedule of the upcoming FP webinars. And until the next time, right, guys, I hope to catch you all again. Trade safe, stay safe, and take care. Goodbye.